A child born today opens their eyes, owing more than they own. Before they take their first breath, before they speak their first word, they inherit nearly $40,000 of global debt and obligation created long before their existence, but one they will spend a lifetime navigating. Governments reassure us that debt is progress, that borrowing is the price of modern life. But history tells a colder story. No empire that crossed this threshold ever returned to stability. Not Spain, at the height of its silver frenzy. Not Britain, as its empire strained under 2 world wars. Not the Soviet Union in its final years of denial. Each believed their system was exceptional. Each collapsed under the weight of promises they could no longer afford. What we call debt is not just accounting. It is a quiet architecture of control. A mechanism that decides who rises, who struggles, and who remains obedient. And somewhere in the last generation, the cage quietly locked into place. We didn't notice the moment it happened, but we are living inside it now. And for the first time in human history, everyday people, not nations, are. The collateral holding the entire system together. To understand the cage we live in today, we have to return to the first civilization that built one. In ancient Mesopotamia, debt was not a line on a ledger, it was a sentence. When a farmer's harvest failed or a family faced famine, borrowing seemed like salvation. But failure to repay meant losing land, children, or even one's own freedom. People became collateral long before the word existed. The first debt prisons were not buildings. They were households stripped of autonomy, absorbed into the estates of the powerful. Centuries later, Rome perfected the system. Nearly 80% of Roman citizens lived in chronic indebtedness to elite families. Loans tied citizens to patrons, votes to obligations, and entire communities to the wealthy few. Debt was influence, and default was servitude. Medieval Europe inherited the same logic. Bonded labor trapped farmers in generational cycles where the only escape was death or revolt. A single bad season could condemn a family for decades. Across these eras, the pattern never changed. Debt began as choice, then transformed into coercion. The more advanced the society became, the more intricate the chains grew. And this pattern has repeated in every empire. By the early 1800s, empires discovered a truth more profitable than conquest. Controlling people through debt was cheaper, cleaner, and far more efficient than controlling them through force. The Industrial Revolution promised opportunity, yet it quietly rewired the relationship between citizens and power. In Britain, company towns emerged where workers lived in owner-built housing, bought goods from owner-run shops, and earned wages that flowed straight back to the same owners. Debt wasn't a punishment, it was a loop. A system designed so workers could never truly leave. Across the Atlantic, American rail monopolies recruited migrant labor with small advances that instantly placed them in debt. The moment they arrived, they owed more than they earned. Their freedom existed only on paper. Banks observed this new dynamic with interest. A worker with predictable wages and predictable needs wasn't just a person. They were a revenue stream, a financial asset. For the first time, debt became scalable. It became a formula that could be exported, replicated, industrialized. Nations didn't need armies to expand influence. They needed lenders, wages, and obligations. And this was the century when ordinary people stopped being workers and became assets. A quiet decision made in 1971 reshaped the global economy more profoundly than any war or revolution. When President Nixon ended the gold standard, the world's reserve currency was severed from the last physical anchor it had. From that moment, money no longer represented stored value, it represented future promises. Trust became the only backing, and debt became the engine that kept the system alive. Governments realized they could print without limit, borrow without restraint, and shift the cost of their choices onto generations not yet born. Banks expanded into global empires, discovering that every new loan created new money, and every new borrower expanded their power. Mortgages surged, student loans became normalized, auto financing exploded, and credit cards slipped into millions of wallets. Debt was no longer an exception. It became the expectation, the foundation beneath every economic statistic we cite as progress. After 1971, every dollar circulating in the world required someone, somewhere, to be in debt. Growth depended on borrowing. Stability depended on borrowing. Even survival depended on borrowing. This was the moment the cage stopped being historical and became structural. And this is the part they never teach in school: the moment money and debt became the same thing. Its consequences still shape every crisis we face today. Beginning in the 1980s, a strange paradox took shape. Productivity kept rising, yet wages barely moved. For the first time in modern history, people worked harder while falling further behind. But instead of confronting the decline, governments and banks offered a seductive substitute. Mortgages made homes look affordable, even as prices soared far beyond incomes. Student loans expanded access to education but quietly inflated tuition, because universities knew the government would guarantee payment. Healthcare costs spiraled for the same reason insurance and credit cards masked the true price, allowing hospitals to charge whatever they wished. Every problem seemed solvable with borrowing. Every political promise was financed with debt. And every year, the system required more of it. What looked like opportunity was actually dependence, a slow shift from wages to credit, from ownership to obligation. The middle class didn't notice the change because it happened one loan, one signature, one monthly payment at a time. Behind the scenes, a new financial machinery emerged. Algorithms studied a citizen's lifetime earnings, forecasting how much they could be expected to repay over decades. That projection your future, labor became a tradable asset. Loans were bundled and sold like products on a shelf, each representing years of someone's life. This was the turning point, the quiet transformation. This was when people unknowingly became the collateral for a $300 trillion system. Every major empire believes its story is unique, yet their collapses follow a pattern so consistent it feels scripted. The same 6 stages appear across Spain's silver-fueled downfall, Britain's post-war decline, the Soviet Union's final unraveling, and Japan's lost decades. The first stage is always the same: easy credit. Borrowing feels harmless. Prosperity feels earned, and citizens believe the good times are permanent. Then comes Stage 2, asset inflation. Homes, stocks, education, even basic necessities drift out of reach, not because they are scarce, but because debt has artificially expanded demand. Stage 3 arrives quietly. Productivity stalls, wages freeze, and consumers rely on borrowing to maintain the lifestyle their parents once afforded with a single income. Debt stops being a tool and becomes a substitute for growth. Stage 4 is the saturation point, the moment households, corporations, and governments hit the ceiling. We can't borrow anymore. This is when the system begins to shake. Stage 5 is the most dangerous: social strain and political denial. The middle class grows angrier. Polarization deepens, and leaders refuse to acknowledge the structural cracks. They promise recovery, but deliver more debt. Finally comes Stage 6. Reset. It may take the form of a currency shift, a default, or a forced restructuring, but no empire has escaped it. And today, most nations are already in Stage 5. The United States is drifting toward Stage 6. This is where collapse accelerates. In the modern economy, loans no longer remain with the lender who issued them. A mortgage, a student loan, even a credit card balance is bundled with millions of others, sliced into financial products, and sold to investors around the world. The borrower never meets these investors, yet their monthly payments feed entire markets. What used to be a personal obligation is now a commodity, and the person behind it becomes something else entirely. Collateral. Credit scores transform behavior into data points, quietly shaping who receives opportunity and who is locked out of it. A missed payment, a medical emergency, a moment of hardship can follow someone for years, determining the price of their future. Banks view borrowers not as individuals, but as streams of predicted income via labor mapped, measured, and monetized decades in advance. Digital IDs and fintech networks tighten the chain. Every repayment, every delay, every purchase becomes part of a permanent profile. The system no longer needs walls or overseers. It operates through algorithms that never sleep. This is the modern version of debt bonded silent, automatic, and global. And it is the digital chain most people never notice. Collapse is never predetermined, but history leaves little ambiguity about what happens when debt grows faster than productivity. Every empire that crossed that threshold eventually faced a reset, sometimes abrupt, sometimes disguised as reform, but always transformative. The lesson is not despair. It is awareness. A society cannot change a system it refuses to see. For 50 years, the debt cage has been built around us, one policy, one loan, one promise at a time. Whether we break it or inherit it depends on what we do next. History rarely gives second chances, and this generation may be the last to receive one.